In this week's video, we'll review the latest charts and data to help us answer the question, how far could stocks fall? We'll take a look at support, context, the economy, asset class behavior, and primary trends. The following slide was covered 8 weeks ago in the June 16th video. And even though the charts looked really good on June 16th, it's inevitable that a giveback and/or correction is coming at some point, which means recent weakness falls into the 100% normal and to be expected category, and none of us should be surprised. We covered this chart dated August 9th and once again talked about realistic expectations relative to how markets operate in the real world. It's not likely that a slope from point A to point B is going to be sustained indefinitely. And last week we discussed these levels here as areas of possible support, and as of the close on Thursday evening, we're down at 43.70. This area here, once again, not particularly surprising. Here's an updated version of the same basic chart during Friday's session at 2:09 p.m. Eastern Time. This is the level here, 43.18, this blue line here that we covered in last week's video. The top line here is 43.52. If we look at the chart during Friday's session, we came down into these lines intraday. Thus far, we're at 43.35, and then we bounced intraday. So thus far, this area of potential support seems to be acting as support. Also noteworthy, with the stock market basically flat during Friday's session, all of the commentary that follows still applies. This is the first test of support here. As you might imagine, this area between point A and point B, this is a much stronger and broader area of potential support. We're not making any assumptions about what's going to hold or what's going to be violated. These are simply reference points. Now let's dig into these concepts a little bit deeper to see what we can learn about maintaining realistic expectations during this pullback. This annotated volume-weighted average price chart tells us if the S&P 500 moved from the recent peak here at the end of August down to this area here of possible support, that would be a correction of approximately 6%. If we come down to this area here, about 7.5%. If we go to the lower end of this band here, approximately 12%. And if we came back to these areas of possible support tied to the COVID low and the COVID high, that would be a correction of approximately 15%. If we take the average of this number here and this number here, comes to roughly 9%, and the average of this number here and this number here is approximately 10%. And for the most part, that would represent a garden variety correction within the context of an existing uptrend. In terms of price, to make a significant lower low, we really have to undercut the March low down here. So we still have a pattern of higher highs and higher lows in place, which is the definition of an uptrend. And if we came down to this level, these levels here, and this level here, we would still have a series of higher highs and higher lows, which is the definition of an uptrend. If we get down here, the trend from the October low starts to become questionable. As we noted last week, if the market comes back into these areas here, and then we see what we want to see, which basically means improvement on the shorter term charts, telling us the odds of the primary trend resuming would have increased. If and when that happens, might be an excellent opportunity to redeploy new capital. For now, we haven't seen that, and new capital will continue to remain in the high-yielding money market. This general area down here was a good risk-reward entry point, and it's possible we're going to come back and retest that area. And once again, it's quite possible that that would represent a favorable risk-reward entry point near a relatively long-term base down here. And it's good to keep in mind that retracements from A to B here, from A to B here, those retracements can be recovered very, very quickly, which is another way of saying it's possible that patience will be rewarded. Even if the market comes down into this area here, it's quite possible it could bounce back in a relatively rapid manner. Here's a potentially bearish scenario. Inflation doesn't calm down. The Fed has to continue to raise interest rates and/or keep interest rates elevated, which will eventually cause credit events and cause a recession and a big hit to corporate earnings. Now, if all of that were true, would this chart look like this? The answer is no, it would not look like this. If all of that were true, then the probability of increasing bond defaults would be on the rise. And when investors are fearful of something like that, they will forego the higher yield in the corporate bond market, and they would rather be in safer U.S. Treasury bonds. And really, since this low here in July, this ratio has been making a series, for the most part, of higher highs and higher lows, including the higher high that it just printed in recent weeks. So this chart does not align with a massive credit event being right around the corner. And really what it's saying is what it's been saying for several months, which is, yes, interest rates may be going higher, but it doesn't look like it's going to cause a massive credit event, and it doesn't look like it's going to cause a severe recession and/or a severe hit to corporate earnings. As we all know, that is absolutely, positively subject to change, and it may change very, very soon, but it hasn't changed yet. If we're going to stay aligned with the primary trend, realistic expectations have to be part of that package. There's a gap down from August of 2022. Here's a gap up in early June of 2023. It would be logical if the market came back and tested this area, which would represent a correction of approximately 7.77%. This would be a logical area for buyers to potentially step in. And it's also possible the market will come back and revisit this gap up in this area here, and that would represent approximately a 12 to 13% correction. Nothing particularly abnormal about that number, and nothing particularly abnormal about this number within the context of a primary trend. When we have an area of strong potential support, which is exactly what we have here, and we have long positions, it can be prudent to see what happens here. If this uptrend remains intact, then most likely buyers are going to step in somewhere above this level here. Anywhere in here would be very, very logical, and of course the market could reverse at any time. This is the S&P 1500, extremely broad composite index. If we drop below these levels here, concerns would increase. To make a significant lower low, you really need to take out this low way down here. So even if we violate this level here, it wouldn't necessarily mean the rally off the October low is dead in the water. On shaky ground, yes. Weekly chart, 30-week, 40-week, 50-week, price above, full-bore bullish look. Still looks like an uptrend. If we came back to this breakout area here, that's approximately an 8% correction. Similar situation, if we look at it on a daily chart, 8.4% roughly from this closing high up here. If we review 73 years of market history, what can we learn about 2023 and the current pullback? And from a contextual perspective, if the S&P 500 hypothetically were to have an 8 to 13% correction, how does that potentially compare to the bigger picture? This is the secular bull market from 1950 in the lower left-hand corner of your screen all the way up to the end of 1968 in the upper right-hand corner of your screen. This is the strongest portion of the secular trend. And we're looking at price action, and price action represents the interpretation of all the fundamental data on all time frames. Between 1950 and 1968, obviously, there was a lot to be concerned about. How do we know that? You would not get a look like this. You would not get a look like this, nor this, nor this, nor this. The market does not fall for no reason at all. So the question is, the problems in the present day, are they going to upend the primary trend? This is what it looks like when the answer to that question is no. 1953, we have a pullback. The 10-month moving average in blue holds above an upward sloping 40-month in red. Price comes back to the upward sloping 40-month and makes a stand. You can see similar things happen in 1958, 1960, 1962, and 1966. And it's noteworthy. Price drops below the upward sloping 40-month moving average, but it's a very short stay, which is typically bullish. And the 10-month crosses below the 40-month. Also relevant. When this happens, in this case, the low is already in. In this case, when blue crosses below red, the low is already in. It's true in 1966 as well. That speaks to an overshoot within the context of a strong uptrend. An overshoot, an overshoot, an overshoot. On your screen here, secular trend 1950, 17.5 down here. You can see price was down here, 1950-ish. And then when we get to 1968, all the way up over 100. So let's just call it 107.5. That represents a gain of approximately 514%. The point of the exercise is not to say we've got 514% of gains ahead of us. The point of the exercise is to say if we have several years of gains ahead of us, these numbers over here, if we experience an 8 to 13% correction, or maybe even a 15% correction, if it doesn't unseat the primary trend, then by definition, the primary trend will eventually make a higher high. Not a prediction in any shape, form, or fashion, but that's what uptrends do. So this number up here, 514%, provides some context for this number here and this number here. Potential downside, logical downside in the S&P 500. Now, let's compare and contrast the look of the 10-month moving average, the 40-month moving average in price during a secular bull market relative to a period of secular stagnation. From this point here, January of 1969, come all the way out to the end of 1977, stock market is lower on an absolute basis. Point B is lower relative to point A. Once again telling us the stock market does not always rise over longer periods of time. So unlike this point right here, where blue drops below red, but price has already bottomed, in the big drawdowns in the period of secular stagnation, that's not what happens. Blue drops below red here, and price continues to fall. Blue drops below red here, and price falls for a long, long time. This and this look significantly different relative to this, this, and this. And all of this looks significantly different from the secular bull window from 1982 here all the way to the year 2000 up near point B. So this is your transition look in here, 1977 to the end of 1981. And unlike this look here, and unlike this look here, both followed by significant additional drawdowns, 1982, 1984, 1988, 1990, 1994, they look a lot more like 1953, 1958, 1960, 1962, and 1966. This is within the context of a secular bull market, and everything walking forward from 1982 is in the context of a secular bull market. And once again, price action and the look of the 10-month and the 40-month during a secular bull market looks significantly different relative to the period of secular stagnation with very large S&P 500 drawdowns. The common look during a secular trend is that the 10-month moving average makes a stand near an upward sloping 40-month moving average, and if price drops below and blue drops below red, it's a short stay. Once again in 1982, you get the cross and price bottoms soon thereafter and retakes both moving averages. Blue holds above red here, holds above red here, and holds above red here. This is a kiss look, and this is a kiss look where the 10-month comes in close proximity to the 40-month in red. All of this indicative of a strong bullish trend that's not yet ready to roll over. And as we know, all good things must come to an end, and eventually the market will need to consolidate its gains. So when we walk forward from the year 2000 up here, really boring things happen for a long period of time. Once again, point A over here is higher than point B over here. So the stock market does not always do wonderful things over a 10 or 12-year period. And once again, when blue crosses below red, price action is significantly different, and when that happens, significant drawdowns follow. Once again, price action when blue drops below red is significantly different from the secular trend look, and really bad things happen with additional drawdowns, significant drawdowns, near 50%, near 50%. We believe the new secular bull market began in 2013 when we exceeded this high and exceeded this high. Thus, any drawdown after that, if we're in a secular trend, it shouldn't look like this, and it shouldn't look like this. It should look more like this or this. So this is the end of 2012. And this is the beginning of the shift away from the period of secular stagnation. And in 2016, we have a fairly significant drawdown. Blue holds above red, a little bit of a kiss look here, and price holds above an upward sloping 40-month moving average, right out of the secular bull market textbook. How about recent price action? Does it look more like this? Does it have a similar and concerning look to this? Or does it look more like 1953? Or does it look more like 1982, 1984, 1988, 1990, and or 1994? Probably fair to say in 2016 we switched back to a secular trend look. It's also probably fair to say that near the low in 2022, we maintained a secular trend look. Price with a very short 1-month stay below an upward sloping 40-month moving average. The 10-month moving average comes back and kisses the 40-month but holds above it. And price, within relatively short order, retakes the 40-month, retakes the 10-month, and the slopes of both of them are up. And on August 16, 2023, at the moment, we have a full-bore bullish look right out of the secular trend textbook. This is exactly what you would expect a secular trend to do. We don't know if this attempt is going to succeed in this window here, but for the most part, every day that's gone by walking forward from, let's say, the March to June time frame, we become more confident that this comes from the secular trend script and really doesn't look anything like the massive drawdown secular stagnation script. If we review August of 2023 objectively and compare it to all of the looks walking forward from 1950, all 73 years, a very short stay below an upward sloping 40-month in red. Then, in relatively short order, price recaptures both of the moving averages. The 10-month moving average in blue comes down and kisses the upward sloping 40-month in red, but holds above it. And then in relatively short order, relative to the low back here, just a matter of months, we've reestablished a full-bore bullish look, with blue the fastest moving average on top, red the slowest moving average on the bottom, price above both moving averages, and the slopes of both moving averages are up. Mid-August 2023. Thus, it's probably fair to say the best match here is either 1953 or 1960. Still a good match, still a good match, still a good match, but this is probably better, and this is probably better relative to August of 2023. The same is true here. 1988 is most likely the best match. Why? Price comes down right to an upward sloping 40-month moving average, most likely cut through it intra-month and then closed with this look here. The 10-month moving average comes down very, very close to the upward sloping 40-month. Price makes a stand and soon thereafter, several months later, recaptures the full-bore bullish look. This looks a lot like this. This is similar, 1994, similar in 1990, similar in 1984. This is probably the least similar out of this subset here, with 1988 arguably being the best match. This has a lot in common with this and this. Also noteworthy, the 1988 window, not only does price action, which basically means human behavior, look similar, the past actions of some traders, but the demographics also look very similar. 1988 to 1994. As we've covered in the past, 1988 to 1994, the median age of a baby boomer was 36 years old. Median age of the largest demographic in the United States will be 36 between the year 2022 and 2027, basically identical to this window up here. And we know that's relevant because in 1989, 100% of the baby boomers were in the prime working age window between 25 and 54. So the 1988 to 1994 window is similar to 2022 to 2027. And we know from past videos that the gain in this window here in the S&P 500 was approximately 86%. Demographics are similar. Price action is very similar. And notice in this case, when price retakes blue and red and their slopes are up, you have not exceeded this high. Price retakes blue and red and the slopes are up, we have not exceeded the prior high. So in 1989, 100% of the boomers were between 25 and 54. 2023, 100% of the millennials between the age of 25 and 54. And Generation Z right behind them, the oldest from Generation Z just now entering the economically important age 25 window, and that will continue to improve over the next 12 years. So why is this relevant? Because it's not really this move from A to B or A to B or A to B that we're particularly concerned with in this environment. As long as it looks like a secular trend, and it still does, we're interested in the primary trend, the bigger picture. Jesse Livermore, the big money was not made in the individual fluctuations. The big money was not made in the individual fluctuations, but in the main movements, that is, not in reading the tape, but in sizing up the entire market and its trend, which is the purpose of this entire segment in this week's video. Sizing up the entire market and its primary and/or long-term trend, which is still unquestionably up at the moment, a series of higher highs and higher lows. Having said that, the short-term trend is unquestionably down from point A to point B. We have not seen enough yet to say that the short-term base case, until proven otherwise, is anything other than more downside and or more pain until proven otherwise. But as noted on Short Takes this week, this move, based on what we know today, is still easily classified as a counter-trend move within the context of an existing uptrend, which implies that when we come down here, eventually we will continue with a series of higher highs and higher lows, implying that eventually this high here will be exceeded. And if we're able to hold our positions, then our balances at this point here will also theoretically and hypothetically be exceeded. Not a prediction in any shape, form, or fashion. Commentary based on the charts in front of us. Also noteworthy, all of this here is occurring above an upward sloping 200-week moving average, which tells us price action in the present day still looks like a healthy and ongoing secular trend that was reestablished between the October low and sometime, let's say, in the mid-May timeframe of this year. If we look at the weekly chart here, good reference point around this breakout level, just above 4,200. Would also say that the base case in the short run is more pain until proven otherwise. This is the weekly chart as of the close on August 16th, but it's highly unlikely that the 10-week, 20-week, and 40-week moving averages in blue, red, and green are going to change significantly regardless of what this chart looks like as of the close on Thursday or Friday. And it's this type of look in here that would be a yellow flag, not a red flag. First yellow flag would be the 10-week dropping below the 20-week, and you can see that doesn't appear likely that that's going to happen in the short run. So this still looks like a strong weekly uptrend, and this looks like a pullback within the context of that uptrend. A pullback within the context of the uptrend, a pullback, a pullback, a pullback, and a pullback. If this morphs into a look like this, then concerns would increase. For the most part, we see a full-bore bearish look in April of 2022. How about the economic data? Drawdowns tend to be much, much larger that are associated with recessions. Common sense tells us that recessions occur when A, B, C, D, and E occur for the most part. August 17th, these charts do not look recessionary. The National Bureau of Economic Research, they're the ones that determine whether or not the U.S. economy is in a recession, and they say in recent decades, the two measures we have put the most weight on are real personal income less transfers, basically how much money you're making, and non-farm payroll employment. Do you have a job? Can you get a job? Which speaks to all of these bullet points here. So if these are the two most important data sets, how do they look if we look at them in detail? Real personal income excluding current transfer receipts. Covered this chart, data in May earlier this year. It's improved since then. This is what we look like, latest reading in June of 2023. If we zoom in, this is what the data set looks like looking back 1 year. It just does not, at this point, look recessionary. That can change at any time, but we just consolidated and broke out and made a new multi-month high. Total non-farm payroll employment. Does it look like this? Does it look like this? Does it look like this? It does not. In fact, if we look at this data set over the past year, it does not scream imminent recession. July of 2022 here, inflation has and continues to come down, and it has dropped significantly. And it is quite possible that if the Fed has to hike 1 or 2 more times, which is well within reason in terms of possibilities, and has to keep rates elevated, that we could see a recession sometime between Q4 of this year and maybe Q1 or Q2 of next year. Something that we talked about in detail in last week's video. Remember, we talked about the similarity between the chart on July 31st, 2023, 1989 window, once again after the 1987 crash. Very similar look. If you know your economic history, a lot of concerns about the stability of the U.S. economy after the 1987 crash. A lot of worries about a recession. But from this similar look here, if you were overly concerned about a recession in the short run, wasn't particularly helpful because the S&P 500 gained an additional 18.85% before the recession became an issue. The NASDAQ 100 gained an additional 22.8%. And by the time the recession was declared in April of 1991, not only had the S&P 500 bottomed, but it had made a new all-time high. Yes, that's correct. By the time the recession was officially declared, the S&P 500 had already corrected and then printed a new all-time high. And by the time the recession was declared over on December 22nd, 1992, the S&P 500 was significantly higher. The recession was from July of 1990 to March of 1991. July of 1990 to March of 1991. And after that, we recaptured the 10-month moving average in blue, made a stand, the 40-month moving average, something that we've already done in 2023. We promised a segment about asset class behavior and primary trends. Remember, we said earlier, relative to our time frame, a yellow flag would be if the 10-month moving average in blue crossed below the 20-month. And if we went into a full-bore bearish look, as we did in the spring of 2022, that would be concerning. On August 17th, 2023, relative to the moving averages, we still have a full-bore bullish look, with blue the fastest moving average on top, not particularly close to red, and not close at all to green. So this looks more like something in here relative to this area in here. And as we know, that may be subject to change, but right now this looks like a pullback within the context of an existing weekly uptrend. The market is concerned about interest rates, and rightly so. This chart aligns with that. Blue, the fastest moving average, is now on the bottom. That would be majorly concerning if we had made a major recessionary bet and we made a very big bet on bonds rather than stocks. But this aligns with, rather than contradicts, a topic that we've been talking about for several months now, and that's that the secular downtrend in interest rates is most likely over, which is what this looks like here. So this doesn't contradict anything that we've been talking about in recent weeks and months. It aligns with it. It aligns with the theory that bonds could significantly underperform stocks. But all things being equal, when interest rates rise, that's a concern, something that needs to be respected. But we don't want to overreact either. This is IEF. This is the gap up here when all of the bullish activity started. We came back to that gap in March and we held. We're back in the gap now on August 17th. So let's see what happens here, and we'll learn something either way potentially about interest rates. The look of this chart here intra-week also aligns with the theory that the bias will be for higher inflation and higher interest rates. And that could be in play for a long time. And we also know that we've covered, this is 1950 here, this is U.S. long-term interest rates. Interest rates rose significantly between 1950 and 1968. Interest rates rose significantly between 1950 and 1968, and that occurred within the context of a secular bull market. If you look at all of the charts that follow, it's really nothing new. It looks like the market believes that interest rates are most likely going higher and that the Fed may not be done hiking yet. But that won't necessarily kill the bull market and or the economy. Because if it were going to kill the bull market and the economy, we wouldn't expect risky leveraged loans to be performing well and to be in a weekly uptrend. And to break out of a multiple month consolidation pattern. Relative to this gap here and relative to interest rates trying to print a new weekly high, we have to keep in mind we've got Jackson Hole next week. Big Fed event, so that could impact interest rates positively or negatively. Dow, full bore bullish look, August 17th. Emerging markets, one of the weaker areas of global stocks. Still with blue the fastest moving average on top. More of a consolidation look at this point than a rollover look. Still well above the October 22 low. When we look at this, does something like this look like it's right around the corner? Semiconductors, like a lot of tech and growth ETFs, does it look extended? Does it look like it's due for a normal and healthy pullback? Potentially. Does it look like an uptrend that's about to roll over? It does not. Does the high-yield bond market believe that default rates are about to spike? and that higher interest rates are about to derail the economy and corporate earnings? It's difficult to say that based on the chart in front of us. Even more so when we look at HYG high-yield bonds relative to IEI. Right now, market participants do not seem to be particularly concerned about a massive increase in corporate bond defaults, even in the high-yield space. So they would rather own the higher-yielding HYG relative to the more conservative IEI intermediate-term treasuries. This weekly chart, while it may pull back sharply, has still been making a series of higher highs and higher lows, and the last thing it did was make a significant higher high above this high, this high, this high, and this high. August 17th, during the session, maintaining a full-bore bullish look. S&P 500 made its most recent high on the last trading day of July. It's now mid-August, and thus far, credit spreads have not widened. This looks significantly different from this, and this looks significantly different from this. This turn here, almost the polar opposite of this turn here, early 2022. The look of the moving averages here says this trend is really stronger than the trend in this window here. This doesn't really look like this. Could we see a significant pullback? Yes, we could. Home builders are very volatile. Primary trend up. Small caps have been a laggard. They even look like they're in a consolidation mode rather than bearish mode. Primary trend up. This is the transition of defensive staples relative to the S&P 500. Late 2021, the NASDAQ peaks here into Q1 of 2022. Blue crosses green. Blue has already crossed red. We don't really have anything like that on August 17th. Chart dated August 17th, 12:52 p.m. Eastern Time. Defensive XLP underperforming XLK by 1.58% during the week. This really doesn't look anything like this concerning turn here. Similar situation, defensive staples relative to semiconductors. XLP underperforming SMH by 2.43% on August 17th at approximately 1 p.m. Eastern. Doesn't look like excessive fear at this point. Is it possible that this will morph into something like this? Absolutely, positively, yes. All of the commentary in this week's video, like every week, is based on the charts in front of us. Very difficult to make the imminent recession argument and that the Fed is going to have to cut rates aggressively argument based on this chart here. This is the S&P 500 relative to 3 to 7 year treasuries. Same comments apply to 7 to 10 year treasuries. SPY divided by IEF started consolidating in October of 2021, went sideways until just recently broke to the upside. Right now, August 17th, we have a full-bore bullish look on the weekly chart. Givebacks, corrections, 100% normal and to be expected. Major low in the S&P 500 2016. This is the risk-on look with the ratio above an upward sloping 200 week in green. Major low, COVID here. Here's your risk-on look after the major low. This is the look that we have in the present day. Still looks constructive. It's another chart that says even if interest rates rise, the market is not anticipating a major disaster, a major credit event, or a major hit to corporate earnings and or a recession. Once again, that's based on the chart in front of us on August 17th. Give back, yes. Significant give back, quite possible. Primary trend, still up. Equal weight tech sector. This recent bullish turn looks significantly different relative to this bearish turn in Q1 of 2022. Everything that we just said about the last chart applies to SPY as well. Blue, the fastest moving average, is on top. Green, the slowest moving average, is on the bottom. Even if Friday's session is incredibly weak, it's not likely that we're going to morph into a look like this. This is what a bearish transition looks like. This is what a bullish transition looks like. Communications services was a significant laggard. This is a sector in the S&P 500 index. It's maintaining a full bore bullish look. Counter trend moves happen in downtrends, and counter trend moves occur within the context of an uptrend. Industrial sector speaks for itself. Tech sector extended, yes. Could we get a give back? Absolutely. A significant give back? Absolutely. Primary trend? It's still up. A lot of volatility in this window here within the context of the primary trend, and there was still a lot of upside. This is what risk off looks like here in Q1 2022. This is what the present day looks like. Very volatile, yes. In an uptrend, yes. The market has moved a long way in a short period of time, and we have a slope like this. Shorter-term traders are almost looking for an excuse to take profits. Not surprisingly, the primary driver of the declines this week, interest rates, something that we talked about in detail in the June 23rd video. The current pullback is a small snapshot of the different world that we've talked about. Market's still concerned about inflation, still concerned about the Fed, and still concerned about interest rates, and that tends to lead to increased volatility, which means if we're going to stay with the secular trend, most likely we're going to have to tolerate volatility, and we're most likely going to have to tolerate larger drawdowns than what we would prefer to tolerate. Haven't seen anything this week that contradicts the concept of a major shift. We're all going to have to adjust. The drivers have changed. And in this environment, gaps, givebacks, and volatility 100% normal and to be expected. The data that we have in front of us allows us to think longer term. All of these bullet points still apply. The Fed, inflation, and interest rates, main topic of conversation this week, and will most likely be the main topic of conversation next week with Jackson Hole on deck. Relative to the title of the video, are you fair to say the base case is a drawdown similar to what we've already seen in the 5 to 6% region, maybe coming down into this region here? It's also probably fair to say that this is within the realm of possibility, but we wouldn't include it in the base case at this point. And hypothetically, if the market does come back into this region, in this area of possible support, provides support, we move in this direction eventually and go on to make a higher high, all of this would be a healthy retracement, and it would increase the probability of having a sustainable trend from a longer term perspective. So we have to keep all of this in this context, and in this context, and in this context. There's numerous ways to look at trends. This is the 20-week in blue, the 30-week in red, the 40-week in green. It's a full-bore bullish look. This looks a lot like this and really doesn't look anything like this. And there are numerous questions we can ask, such as, is the S&P 500 above the 200-day? Is the slope of the 200-day moving average up? Is the 20-week greater than the 30-week? Is the 30-week greater than the 40-week? What does the slope of the 50-week look like? Is price above the 200-week? Is the slope of the 200-week positive? Price above the 50-month? Is the slope of the 50-month positive? The answers to these questions significantly different in this window relative to the answers on August 18th, 2023. And the fact that the answers are all yes tells us a great deal about the longer-term probabilities. Unquestionably, the primary trend is up, which means the trend for investors is favorable. It may not be favorable for traders. And it would be great if stocks could go up every day, but we all know that's not possible, and that's not the way things work in the real world. It's extremely important that we maintain realistic expectations. And if we were to ask and answer, the data that we have in front of us today, does it align with or contradict the secular trend thesis? The data that we have in hand today and all of the charts that we covered this week, do they align with or contradict the concept of a major shift in interest rates, which will impact asset allocation and portfolio returns potentially for decades? Does stock market volatility this week, primarily induced by interest rate volatility, align with or contradict everything that we've been talking about? Interest rates have been rising for some time and quite rapidly, and yet we can still check all of these boxes. Does that align with or contradict the concepts that we discussed in the 1950s, where rates were rising in the context of a secular trend? Does all of this align with or contradict the theory that there could be significant gains still ahead of us over the next several years? And does all of this, the facts that we have in hand today, does it align with or contradict the positive demographic trends that we've been covering? And as always, we're not making any assumptions about any topic on any time frame. And we all know, if we're going to successfully navigate walking forward, it's important that we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.